I'll tell you a simple instance. I'm also part of Hyderabad Angels. So we get a lot of companies every month, right? 3 companies every month to come and present. And some of them are actually late stage companies. So we said no to one company. While we liked the entrepreneur a lot, the idea was great. Only because the entrepreneur just had 20% of the company. The remaining 80% of the company was with people whom he gave it away at the initial stages because he needed money. So what happens then? The 80% people who have the share don't add any value. They just took it because they happened to give some initial money and they took the 80%. But he stuck with 20%. When he's going to raise some more money, his shares are going to get diluted. And then slowly he'll lose interest. It's not enough money for him, then he'll move. Right? So that kind of an investment is risky for us. So we want the founders team, the key team, to hold the majority of the equity. Okay? And then the investors, whoever have invested, not to have too much equity in the system. I mean, they have like 20-30%. That's fine. Not more than that. So that's one filter. Any questions?
In bit more detail, actually, few of your companies have been invested by external investors, right? The previous companies are fixed.
Yes.
So can you give us a flow kind of thing on how you reach these stage?
Yeah, and it's different for different companies, right? I mean, for example, Vanga was a Valley company, right? The entrepreneur was very successful. He failed once. The first startup he failed. The second startup he was successful, and this was his third startup. He had enough money to fund the company. I mean, he came out of an exit of $100 million. So he had enough money. But he never put his money into the new startup. Okay? He raised $2 million. And he raised probably about $500,000 from people that he knew, friends and family, just to be nice to them and ensure that they benefit from this whole thing. But the remaining 1.5 he raised from very critical investors who can help grow that company. Okay? So people who are in the educational software business, people who are in the gaming, people who are in content design, because those are the kind of people he needs to scale the company. So it's very important why you should choose an investor. You should be in a state saying, I don't want money from you, but I want money from you. Because I think you will add value. Okay? So that's important. So don't try to take early money from people who will not add any value into that thing. If you just want to be nice to friends and family, give some equity to them and be nice to them. But ensure that the other investors, you need some anchor investors. So the rule of the thumb is that if you're able to get one good anchor investor, the other investors typically fall in line. Okay. So let's say if we have Srini Gopulu who was investing, he was Microsoft CEO or whatever, right? So we had then, a couple of us got confidence because we trust his judgment, right? So that happens with even Hyderabad Angels, right? So when we actually evaluate companies, somebody else, some venture capital or angel investor network has already kind of put in some money. That means it gives us confidence that this team can do better. Okay. That initial conversion is difficult, but once you get it, then you're okay. And walking through the path. So he raised about $2 million. He didn't raise any money after that. He said 12 people team, just 12 people. He didn't take salary for throughout that 2 years. Okay. Now in the third 3.5, 4th year of operation, he's trying to raise another $12 million round. Okay. So that's the Valley startup. Okay. They raise up to $1 million or $2 million to start, and then the next round they raise a big round. Okay. And then the third round is the biggest. Right. So in India, however, things are changing. So India, I think you have the liberty to start small. I mean, even if I give you today $20,000, you can still run with it for about 6 months. Okay. The only thing is that when your type of startup is a large e-commerce type startup, right? Then you need a lot of money. it's a marketplace setup, you need a lot of money. You know, sometimes when you go and ask for money, it all depends on the startup it is. So today I have one startup in the portfolio which is at idea stage. It's called Hospro, which is a hospital procurement platform. But just imagine how many people I would need and the kind of platform that I would need to actually make procurement easy for hospitals. So it is an investment. It needs a lot of investment. So if I don't give it the right investment at that stage, it's going to fail. So it's a decision based on your business idea. So that's what it is. So first you do your family bootstrapping, then you build some traction, build your prototype, build some traction, and then take it to an angel investor. Okay? Try for anchor angel investors, people who are famous, people who matter in the system, and then once you get one or two of them, great, then you can raise your next round. Okay? Don't raise money if you don't need it. Okay? I see a lot of times investors and entrepreneurs just say, oh, I need $2 billion. Why do you need $2 billion? I need 50% for technology development and 50% for marketing. Okay. But the 50% of technology development, then when you break it down, and if there is a technologist on the other side in the venture capital firm, he can actually go deep and find out. So take money as much as you require. Okay. What else?
For investors to invest in a team, I mean, how important is a college degree from a premier institute? Do investors also evaluate the credibility of the founders based on the degrees they have?
It does add a little bit of value. Okay, not